Markets bust out of the gates heading into 2018. Just the beginning or the final wave? Also, why charts are a guide and not an absolute. Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget to subscribe to our channel. Also, click show more for additional information, links on today's video. Also, we put a new guide there for everybody, 9 pitfall mistakes that investors make. So make sure you download that as well. So first up, we're going to do a question from a viewer. Why was there a discrepancy on our signals? And now for those who wait the whole video, we do our signals at the end. Today, here you go. All positive. Short-term, mid-term, long-term. And these are based on momentum of the market. 1 day, 1 week, 1 month, etc. The other one that we have is from Stock Charts, our charting program that we use. As you see here, everything is green across the board. S&P, Nasdaq 100. S&P 100 and Dow Industrials. So how do we use them? First off, think about portfolio construction. Let's talk about a 60-40 portfolio. 40% would be split between bonds, 38, and 2% cash, which is where we are now. And then the 60% is split between short-term, mid-term, long-term, and sectors. And yes, they are actually separate portfolios. You can also link each of those, short-term to our daily charts, mid-term to our weekly charts, long-term to our monthly charts. So on the long-term, we'll just split that between the S&P and the Nasdaq, and mid-term and short-term are pretty much identical portfolios, and that's based on which part of the markets that we might overweight, whether it's small cap, large cap, international, etc. And then of course sectors are whatever sectors we're in at that time. So how do we use the signals though? Well, at the end of the day, daily, if we see a short-term indicator go negative, we're not always going to react because of what we saw last week. Last week, the market started out momentum, MACD on the downside, and of course shot up. So you have to be careful with that. But we will use that for an entry point, an opportunity to get into the market. We will react though, when we see deterioration on weekly and monthly, we will definitely react in some way, whether moving out of the market, shorting, or going to cash, depends on what we feel at that time. So hopefully that helps. Let's get right to the numbers. And yes, they were very nice last week. When you look across the board with our core sectors, strong. Obviously, S&P up 2.6%. Nasdaq came back to life, 3.38 after really a flat 3 months. So across the board, and then small and mids still struggling a little bit. So now let's take a look at the big charts. First up, S&P. We talked about this last week where it went negative and then shot off. So each time here in the S&P, you see a consolidation and then a move higher. So a good looking chart. How about the Nasdaq? A little bit of a different view. Here, you've got all these bullish flags, which are very defined by the yellow there. We had the MACD turn over here, and again, shot up as well. So, I mean, across the board, when you look at charts, short-term, daily, we're not moving in and out because of the changes that can happen so quickly. How about the Dow? The Dow has just been, I mean, crazy. Last year, we had 71 all-time highs, and how about 4 just last week? And oh yes, there were just 4 trading days. So the Dow has gotten off to really another great start. Crazy to see the move on the Dow, which is generally a little bit behind the S&P. How about the Dow theory? Transports and Dow reaching all-time highs together. Very bullish and very much in play right here. So again, more good signs on the market. Market breadth, B-R-E-A-D-T-H, right? Breadth. When you look at that, the 200-day moving average, so that's going to be our monthly view. So how many companies are above the 200-day moving average? Strong. Across the board, we had a surge. S&P 82%. So above 60s bullish. Anything above 50 is good, and below 40 is bearish. So you look at mid caps going down, 74 to 77%, Nasdaq 73 to 83, and small caps kind of holding its own there at 71 going sideways, but strong breath. And then on the short term or shorter term view, 50-day moving average, again, S&P went from 73 to 83, strong. Nasdaq, 60 to 88% of companies above their 50-day moving average, mids up to 76, and smalls on the shorter term, 59 to 68. So again, a very bullish view there. Let's take a look at our sectors. So first up, across the board, we had 7 of 10 sectors last week hit all-time highs. The laggards, retail, utilities, and consumer staples. So across the board, very bullish when you have pretty much a broad participation. We're going to go back and take a look at our oil. As we've talked about, we started tiptoeing in the fourth quarter with some individual accounts, and then we added that to our sectors, and we did get the breakout last week. We held 60, went above 60, and you can see your resistance. We went above that, so that's a very bullish sign. The next one, back from the dead. This does not make sense. So when you look at this, and we're going to talk about treasuries, these are opposite of what should be happening in a market that's going up. Gold had 11 straight updates. That is a record, the most in history. They've been tracking since the 70s. So when you take a look at that, number one, besides breaking through resistance, we then had a trend line we broke through. Wow, gold looks really good. Now, I'm not going to get in there yet, but I'm going to continue to watch this. But very interesting to see the gold bugs make such a big move last week. So let's go to treasuries. We've been talking about this, the deterioration of yields. 10-2 held at 0.51. The other thing that's really interesting, and the reason this happens, you can see on the chart. Your 2- and 5-year are going up. Your 2-year at 1.96 has not been this high, above 2% since September of 2008. We're at 1.96. Again, very concerning. We've got yield spreads dropping, inflation starting to pick up a little bit, so going to continue to watch this story. Now, my contrarian view, because I have to. Yes, everything we talked about so far is bullish. There's no question about it. So that's why all signals are positive and we're fully invested right now. But you still have to look at the other side. Here's something I haven't talked about in a while. We have a link below. The Elliott wave theory. Now here's our weekly chart. The Elliott wave basically talks about a couple things. One, there's 3 upsides of a trend, but there's 2 downsides. Now we had our first move up from the low of 09, came down, there's 2, up 3, down 4, and our final wave is where we are right now. So very interesting to see this come into play. And of course, we're in the weekly chart as overbought as we've been since 1996. Now another simple way, follow me on this math, okay, it's actually been around for over 100 years. So what you do is, how far is the uptrend might go, triple the size of your first up leg. So remember, 1, right, when we're down to 09 for your first up leg. So in that case, the bottom to the peak of 2011, the first up leg was 704 points. You take 1370 minus 1666. Times 3, you follow me here? And then we add on the original number of the market, okay, which is the 2009 bottom. So if you were to take that 3 times 704 to 2112, you to add in the bottom, it's 2778. 35 points from where we closed on Friday. Interesting. The next one, the monthly. When you look at the monthly view, this is the most overbought we've been since 1958. That's 60 years. That's crazy. So when you look at these overbought conditions, yes, it concerns me. I also included an article below from Jeremy Grantham, bracing yourself for a near-term melt-up. We've talked about that in the past. Great article. Again, a link below that you can check on that. So here's a chart from Dana Lyons. You can follow him. I'm sure Michelle's going to put his Twitter handle here. AAA stock allocation, 72%, the highest since 2000. How about bullish versus bearish assets? How about 10-year high in both? So bullish assets, those meaning growth, highest we've seen in 10 years, the lowest on bearish type assets. But this time's different, Michael. How about the Wall Street Journal of September 1999? Remember the Dow Top 10,000? It looks like if this is a bubble, it's sure tough to pop, but I think we know what happened there. And the last one here, just a little amusing cartoon I saw last week. This is true. Everybody wants in. I talked about the end of the year, I lost a 78-year client who didn't think I was being aggressive enough. And I'm getting people saying we need to be more aggressive, and everyone wants more return, but are they willing to take that risk where sometimes that diversified portfolio works out a little bit better. Now AAII again, the numbers 59.8%. Everybody's euphoric right now. Remember that John Templeton, right? This is the highest level in 7 years. Fear and greed, you got it. Back to greed. So as we head into this week, yes, bullish signs everywhere, but this market continues to be stretched, and that's why I'm looking at it and say, look, we're all in, but we're just looking for cracks if they come. As always, we appreciate you watching. Michael Loftus for Wealth and Wisdom TV.